Hello everyone, this is Preet from NBFX and this is a video about EMAs, or Exponential Moving Averages, and how we can use these indicators to trade with. So let's start with what they are. EMAs are a very popular technical analysis tool used in finance and trading. I personally use EMAs in my strategy and have found great success with this indicator over the years. EMAs can be used to identify trends, determine support and resistance levels, and generate trading signals in some circumstances. To define an EMA, an exponential moving average is a type of moving average that assigns more weight to recent data points. Unlike simple moving averages, which give equal weight to all data points, EMAs emphasize the most recent data. The image on the left with the green and red lines shows what EMAs look like when plotted on a chart. EMAs are calculated as the simple moving average of a specified number of data points. Subsequent EMAs are calculated using a smoothing factor that incorporates the latest data point and the previous EMA. This is for information and educational resource only. For all intents and purposes, you don't actually need to know how to calculate the EMAs yourself, as these are a common inbuilt indicator in nearly all trading platforms. So why do we use EMAs? What actually are the benefits? Well, EMAs react faster to recent price changes compared to other moving averages, making them way more responsive to recency bias and the most current market conditions. They also provide a smoother line compared to SMAs, which helps in reducing lag and noise in data. Bear in mind that EMAs are one of the most easiest ways to figure out whether a chart has bullish sentiment or bearish sentiment. However, like with many indicators, there are also disadvantages of using EMAs. EMAs, like other moving averages, are lagging indicators. They rely heavily on past price data, which means that if there is a shift in sentiment or a turning point in the market, the EMA will take a little bit longer to confirm the shift, often leading to missing opportunities. You also get what's called a whipsaw effect. EMAs are quite sensitive to short-term price fluctuations, making them prone to generating false signals during volatile and choppy market conditions. Rapid price reversals can lead to whipsaw effects, where the EMAs can generate conflicting signals. Without practicing and backtesting, this could lead to confusion for any beginner traders out there. So let's move on to usage. How can we actually use EMAs to identify a trend? Well, the most common pair of EMAs seen on a chart is the 50 EMA and the 200 EMA. I personally, in my own strategy, use the 50 EMA and the 200 EMA, as I've backtested this to be the most accurate in identifying a trend. Essentially, once plotted, if the 200 EMA sits below the 50 EMA, then this can indicate a bullish trend. If the 200 EMA sits above the 50 EMA, then this can indicate a bearish trend. EMAs can also be used as a form of support and resistance. Now, this isn't your traditional form of support and resistance, but more of what's called a dynamic support and resistance, which can be used to help traders determine certain entry and exit points when using EMAs. If you are unsure about what a support or resistance level is, then you can watch my video on support and resistance by clicking the top right hand corner of this video now. EMAs can often cross over. Through backtesting, you can find that when the EMAs cross over, this can generate a buy or sell signal. I personally haven't backtested this, so it's recommended that if you want to test this out and incorporate this into your own strategy, then you can. Now let's have a look at some live chart examples of EMAs in action. Okay, so let's have a look at the price chart for UK oil, Brent crude. Here I have the 200 EMA plotted in green and the 50 EMA plotted in red. As you can see, the 200 EMA currently sits below the 50 EMA, which indicates a bullish trend on the 15-minute chart. You can see that the 200 EMA, the green line, is actually acting as a support level. This is a dynamic support level, as you can see, as prices continuously respecting the green line, the 200 EMA average. In addition, the 50 EMA line is also being respected. You can see that price continuously bounces off the 50 EMA, the red line, and retraces back up, slowly inching its way back up, whilst continuously respecting this line. This is a good indication and it shows a good example of EMAs becoming dynamic support and resistance. You can take, for example, a chart like this and base an entry point off this. So you can see, and there is good reason to believe, that when the price touches the green line and closes near it, there is a good bounce back that is probable, meaning that you can easily identify good points of entry on an uptrending chart like this one. Switching over to a more bearish chart, this is the 1 hour chart for Aussie dollar against the dollar. Now, we can see that price has been uptrending in the past, respecting the red line, the 50 EMA, to then gradually come down and cross over around about here into a confirmed downtrend. We can now see that the 200 EMA is currently sitting above the 50 EMA, indicating a downtrend, which is then confirmed by continuous lower lows. We're actually nearing, if we were to look at this chart, we are actually nearing a potential sell point here. Price is looking like it's beginning to slow down as it's nearing the 200 EMA. Should we get confirmation of a bearish rejection at this point, we can look to enter a trade and ride it back down, as we have good confirmation that price is in a bearish trend. So why would we look to take a long? It just doesn't make sense in this situation. A strong rejection off this EMA would be a good indication and a good entry point for a short trade here. Okay, I've just let 3 hours go by and I've checked back in with this chart just to give you a good summarization of how EMAs can work in real time. So, like I mentioned 3 hours ago, if we started to see a rejection off this point here, we would be able to see a downward move. We can see that price is actually starting to move down now and we are getting a bit of rejection, and hence meaning that this EMA level has been respected. So there you have it. That's a basic crash course on EMAs for any beginners new to trading. This is a fundamental indicator that you can leverage in your trading. If you found this video helpful or entertaining, don't forget to give it a thumbs up and hit that subscribe button below. By subscribing, you'll be the first to know when I release new content. Until next time, keep learning and I'll see you in the next video. Take care.